The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service Advanced Technical Analysis course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Let's take a look at this illustration over here. If we look at the technical analysis assessment, we can see that the market has broken a clear resistance. We know that the trend is up simply by reviewing price action from these lows. There is no doubt that the market has been moving in an upward direction. Our most recent evaluation clearly identifies that the market has broken a key area of resistance. We can identify some risk parameters and also evaluate to further reinforce the underlying uptrend that the trend line support is holding. Therefore, we have an additional piece of technical information that tells us this market is going up. The conclusion that we can only come to at this point in time is that the trend remains bullish. Therefore, that represents our directional bias, and because our directional bias is bullish, we are looking for buying opportunities in this particular market. What we can then ask ourselves is, are there any fundamental issues that have been driving the oil price most recently? And in terms of the most recent price action, you can see that the prices at that time had moved higher. The latest development that had occurred in the market, which caused the upward push in price action, was that the White House administration had made a decision to pull out of the Iran nuclear deal. So, a very quick overview in terms of applying some of the technical analysis tools that we've covered thus far in the webinar have given you a strong understanding of the decision that you need to make, and that is to buy this market. By staying abreast of the news, you're aware of the fact that the fundamentals that have been driving this market recently, or rather most recently, has been a development to pull out of the Iran nuclear deal by the US. Therefore, you feel comfortable enough that the market still remains bullish. The challenge for you is, from a technical perspective, to identify when you will be taking a long position. If, on the other hand, let's assume that you are in a very fortunate position where you've been long from this low, you've continued to track the market higher, raising your stop loss accordingly. You may have raised the stop loss to this particular level over here. That would have forced a position to be stopped out. Perhaps on this recovery, you've made a decision, correctly so, either at this level perhaps, or at this level, or even the break of this level to execute a long position. So we just assume at current levels, you remain long. You've used technical analysis to come to the conclusion that you're still happy to be long up at these levels. You've been able to identify your risk parameter, something that we've looked at extensively in terms of stressing this point over the course of the webinar thus far, to identify where you place your stop loss. Let's just, for argument's sake, say your stop loss is currently below these levels over here, which mark the breakout point. You then follow the news and you come across this story and you feel encouraged by the fundamental developments. It's forced prices higher. My technicals are in agreement. I'm still comfortable holding this long position. So the combination of technical and fundamental analysis doesn't just begin and end at the point at which you make the trading decision. It is an ongoing process, just in the same way as analyzing a trend to make decisions about the existing position that you have in place. understanding the fundamentals over the lifespan of the trade is also important so that you can understand what is driving the market and whether the fundamentals continue to be in agreement with the direction of the trend. By simply staying abreast of the news, you can be in, or rather place yourself in, such a position. That then concludes our focus on, firstly, covering some aspects of technical analysis as well as fundamental analysis, overcoming some of the challenges that we all face and obstacles that we all face in the marketplace. Hopefully, you have a better understanding of why technical analysis is important, as well as why understanding what is driving the market is equally important in terms of placing you in a better position to, or rather a more informed position, to be able to assess the conditions that you are either currently dealing with because you have a position or looking to be involved in because you're looking to take a trade on a particular market. We will now move our focus and the discussion of this particular webinar onto sentiment analysis. Now, sentiment analysis is the study of people's opinions, their sentiments, emotions, and attitudes. The marketplace is made up of human beings, the likes of you and I, and thus it is logical to expect that emotions will play a role in decision making. What is great, or rather a good thing in the market, is that the delivery of information is efficient and fast. In essence, this means that the market delivers the information to the marketplace at the same time, meaning nobody gains access or early access to this information to place them in a more advantageous position with regards any trading positions that would likely be made. And information is delivered around the world at the same time. In other words, anybody, for example, looking at a Bloomberg screen, if you're a trader at a big bank, whether you're based in somewhere in China, Hong Kong, Singapore, somewhere in Europe, even in Africa, everybody will receive this information at the same time. So the delivery of information in the marketplace is efficient and fast. That then has the ability to force the market to make decisions quite quickly based on whatever developments are taking place. Over the years, another aspect has come to affect the markets. Social media now plays an important role too in influencing our thoughts and opinions. You've probably come across this mentioned a number of times, is that even within financial markets, we are living in a world of Twitter. Probably the main protagonist around that at the moment is the President of the United States, who is very active in terms of expressing his views, thoughts, and commenting on developments via Twitter. These have had an impact on the market's decision-making process. This is all part of what is impacting market sentiment. Overall, though, when we look at market sentiment and why it is important for us to understand what sentiment conditions we are dealing with, it's because, and from your perspective, it's important to remember that turning points in the market, major turning points in the market, occur when sentiment is at an extreme level. Think about market bubbles, for example. Market bubbles burst when market sentiment is at an extreme. It's also at an extreme because people don't think that the underlying conditions are actually going to change. If we've been in a long-term rosy environment, if we just go back to 2008, we remember the rising house prices that were seen in major economies around the world, particularly in the Anglo world. The view was that prices in houses could not go down. Ultimately, that was clearly not the case. The bubble finally burst and we had a major financial crisis. If us as traders can correctly assess market sentiment, this potentially can also give us an edge, not only in how we trade the markets, but also in what we're looking out for in terms of price movements in the marketplace. So we have to ask ourselves the question, and hopefully we can answer this: how then can I gather information on sentiment? Just like we answered the question with respect to fundamental analysis, if you are able to stay abreast of the fundamentals, this will at least lead you in the right direction and provide some clarity regarding market sentiment. We'll look at this very shortly. If you're reading the financial press or you're looking at various profile pieces, for example, on the financial television stations, seek out areas that provide opinion notes to discuss market-related views, such as hedge fund positioning, market views on the direction of an instrument, and comments on macro conditions. If you can get a good handle on topics such as the ones we've just looked at, you'll be able to get an understanding, or at least formulate some issues in your mind which would then automatically relate to sentiment. We'll look at a few illustrations very shortly. So for example, some examples recently have been, before the financial crisis of 2008, the general view was that house prices were solid and could not or would not go down. The lesson that we can all learn from this is that any asset in financial markets, remember, owning a house is an asset or an investment. Any investment can have a situation where the price goes up and also where the price goes down. So a lesson that we can all learn from this is that the view was perhaps even naive, but certainly misplaced, that house prices could not go down. That then led to a massive bubble which eventually burst, as we all know. If we just look at more recently, in 2017, will certainly be remembered, at least for now, as a spectacular year for anybody who had been fortunate enough to be involved in cryptocurrencies. These markets soared over the course of 2017, and towards the end of 2017, early 2018, when we were looking at Bitcoin, for example, prices of 50,000, even 100,000 had been mentioned as considered possible. Well, unfortunately, if we just look at the last 4-5 months in cryptocurrency prices, and specifically in Bitcoin, the market has moved significantly down from a peak of around 20,000 that it touched in mid-December. Whether these markets eventually do get to 50,000 or even 100,000 is certainly still possible. However, it was clear that after such a spectacular rally, that we were talking about not just a 10 or a 20% rally, we were talking of hundreds of percents, even 1,000% in some of the markets, which is unheard of, so to speak, in financial markets, that even following such moves, clearly talk of 50,000 and 100,000 had suggested that market sentiment was potentially at an extreme. Now, we don't know for certain whether markets are at an extreme, but your ability to be able to, let's say, read these bits of information and perhaps start asking yourself the question, are we at an extreme with respect to sentiment, might force you to make certain more cautious decisions around your trading, or perhaps certainly be more aware of any sudden changes in price developments, which could then be a reflection of market sentiment. As we mentioned earlier, major turning points in markets occur when sentiment is at an extreme. Sentiment impacts crowd behavior, leading ultimately to extreme levels. What we tend to see is that when sentiment changes dramatically, markets react violently because everybody realizes that they are potentially wrong. However, to ultimately also get to this point where we have an extreme level of sentiment, crowd behavior has to have been involved. In other words, everybody is of the same opinion and everyone is taking the trade. That's what has led to the trend. That's what has led to prices either moving up or down, depending on what has been focused on. And that ultimately then leads to an extreme position in market sentiment. Remember though, as we just mentioned, it is very difficult to identify when the sentiment considerations will impact the marketplace. The resulting change in sentiment can be sudden or perhaps take time to develop. By looking at technical analysis, we are able, and studying the charts, we are able to perhaps get an early warning sign, particularly if the change in sentiment takes some time to establish. So to perhaps go to one of the earlier topics that we looked at in a previous webinar, if we are studying price patterns, and let's, for example, say that we're looking at a head and shoulders pattern, perhaps we're looking at it over daily data, and this has taken maybe 6 weeks, 8 weeks to develop. The fact that you've been able to identify a head and shoulders and you understand how to evaluate and analyze the 3 components of the head and shoulders reversal will place you in a good position to evaluate the threat of a change in sentiment. If you have an understanding of the fundamentals, you'll understand what potentially is going on. If there has been a specific reason that has driven markets, you may then be in a position to ask yourself, is sentiment at an extreme level? Because certainly the technicals are suggesting that there is a rising threat of a change in the direction of the market and therefore a change in market sentiment. So if a development takes time, we have a better ability to identify the change by studying the charts. In other words, using your skills around technical analysis. Remember that a significant change in sentiment causes a rise in volatility. So this is also an important observation that you can make from price action. If a market is trending and it's gradually just moving higher without big swings in price action, sure, there will be corrections. Corrections are healthy, but prices are just gradually continue to move in an upward direction. That is a low volatility environment. When things change and the market becomes frightened, prices start to swing in big ranges and perhaps don't even establish a direction. They just move in a more sideways manner. The market is really trying to assess what is going on in the market and what the impact is on sentiment. This also provides a warning sign that you could be dealing either with a change in sentiment or just a reassessment at current levels. Things may settle down and the market may continue to trend up. But it is a warning sign that you need to be on the lookout for changes in market conditions. So keep an eye on volatility, and you can observe volatility simply by the nature of price action. A couple of illustrations in terms of trying to answer the question, what is the market up to? Let's, for example, say you came across a headline earlier this year that hedge funds bet on the euro to fatten up meager returns. In other words, hedge funds are going long euro against the US. Because you're seeing a comment like this, the hedge fund community is long the euro. If the hedge fund community is long euro, it means there are a lot of positions in the market that are long euro dollar. Does that mean that euro dollar is at an extreme in terms of the sentiment because the positioning is potentially at an extreme point? We're not answering the question yes or no. We're just perhaps being a little suspicious with respect to the implications that this might have in terms of sentiment in the market. You might come across another headline that suggests the euro, or that states rather, the euro opened the year at 105, and the overwhelming consensus at the time was for a break below parity. That didn't happen, and it sailed all the way towards 121 in early September. Now, this is a relatively recent market condition, and this refers to the beginning of trading in 2017. The start of 2017, the euro was trading quite low or quite weak. The overwhelming consensus in the market was that the euro was going to continue to move lower with a target of parity. That then basically is just a clear indication from our learning process in terms of looking back at market conditions that bearish sentiment on euro dollar was at an extreme at the beginning of 2017. By September of that year, euro dollar was trading at 121, not at parity or below parity. It had moved in the opposite direction to 121 in early September. So by keeping abreast of the news, you will be able to pick up comments that clearly refer to market sentiment and will provide you with information and at least place you in a position to come to some conclusions about what underlying sentiment conditions exist in the market. This is a recent situation, the reverse of 2017, where at the start of this year, hedge funds began the year with a record $19 billion bet on euro dollar. In other words, the hedge fund community has started out 2018 with a view that the market was, or rather that the euro dollar was going to continue higher. The exact opposite to the start of 2017. Once again, if the hedge fund community has placed a record turnover on the actual trade, then this could be a warning sign to you that sentiment is at an extreme level. Remember, the hedge fund is a significantly large community in the trading world, certainly from the amount of money that is under management. What this headline is telling you is that there's a record long position amongst the hedge fund community looking for it to go higher. Does that give you a significant amount of confidence that yes, indeed, the market will go higher? Doesn't mean it'll go lower, but focus on your technicals to see what is actually going on. And what we'll do to conclude today's webinar is we'll just take a look at euro dollar in terms of what it has done thus far. And the vertical line highlights the beginning of 2018. So 2018 saw the hedge fund community going into the start of the year with a record long position in terms of volume. Euro dollar moved up towards the 125.5 level, having started the year off at around 120.5 or thereabouts. So the year started off fairly impressively in terms of the market going higher. What we don't know is whether hedge funds felt that that was good enough to cover positions or not. Nevertheless, we haven't had any reports that they've scaled out of the position, so our assumption would be that they still remain long. You as the analyst would be able to evaluate the technical conditions in the market, and you would have correctly come to the conclusion that at least as long as this trend remains technically strong in terms of the way price movement is going higher, I still expect it to move in an upward direction. However, for a long period of time, a few months, we saw the market trade sideways, and eventually the market broke lower. So the extreme long position in euro dollar in terms of a reflection of sentiment has ultimately proved that it wasn't enough to continue pushing prices higher, and indeed we are now trading at levels below which 2018 started. So by looking back at that piece of information that we just saw, with respect to sentiment, that the hedge fund community starts 2018 with a record 19 billion bet on the euro. We can use that as a lesson that those kind of statements need to be observed and followed closely as potentially a warning sign that market sentiment is at an extreme. That would then have come to at least gradually begin to agree with your overall technical evaluation, particularly when markets eventually did break lower. Now, what we don't know at this point in time is whether euro dollar will ultimately trade much higher for the remainder of the year, or will it continue to trade lower. What we just simply will continue to do is to analyze and follow price action to evaluate the current market conditions to determine whether we still believe this market is going up or down. But from a sentiment point of view, and certainly if the hedge fund community is still long, so let's assume that they haven't covered the position, then we also know that this information could be a potential bearish threat to the market, because if at some stage the market continues to trade lower, there will be a pain threshold that the hedge fund community will have crossed and will then begin to be forced to close out the positions, having to give up on the long euro dollar trade that they began the year off with in 2018. So not only does access to this type of information provide you with some insight into what you should be looking for next in the market and whether your trend analysis continues to reinforce that underlying view or whether it's a sentiment threat that might see prices move in the opposite direction, but also understanding and trying to see if you can determine whether those hedge fund positions are still open, because they may indeed then become a further threat to euro dollar upside if price action continues to move down. At some point, the hedge fund community will be forced to close those positions. And that is an illustration of how you can incorporate sentiment analysis into your overall strategy. It concludes today's webinar. Just to recap, with respect to today's webinar, we looked at answering the question, why use technical analysis? Focused on some considerations around the use and application of fundamental analysis, looking to stay abreast of the fundamentals, and then always, at least initially, answering the question, are you a technical or a fundamental trader? We then went on to look at sentiment analysis, illustrating how you can gather information relating to sentiment. Certainly understanding the impact of sentiment is important, and then looking at answering the question that you always need to ask yourself, what is the market up to? In the next webinar, we will introduce you to the concept of Fibonacci. We'll be looking at the properties of the Fibonacci number series, looking at answering the question, what are we trying to do? We'll be looking at retracements, price projections, and time projections. We'll then move our discussion onto the Elliott wave theory, looking at the basic 5-wave structure, the impulse and the corrective phase that makes up the 5-wave structure, and then the complete wave structure. We will conclude tomorrow's webinar by illustrating how you can apply indicators as a confirmation tool. Congratulations, everybody. You've now finished webinar 9 of the Advanced Technical Analysis course. Congratulations on completing webinar 9. We have just 3 more to go to complete the Advanced Technical Analysis course. This has been a focus on technical, fundamental, and sentiment analysis, and appreciating the fact that you should bring all 3 of these topics into your trading strategy. Thanks once again for joining, and we look forward to seeing you next time. Bye for now.